Good evening, everyone. We're going to get started in just a few moments. We just opened up the doors and we're still allowing participants in. So if you just give us approximately 1 more minute. Thank you. Okay, so we are just a few moments after 6:30, and I want to be sensitive and respectful to everyone's time, so we are going to get started. I do want to welcome you to tonight's program offered by the Schaumburg Township District Library, and we are welcoming back Linda Dressler with Remax Suburban and Jean Walters with Home Trust Mortgage. They did an excellent session for us just a few weeks ago on selling your home, preparations for selling. And now we wanted to do on your mark, get set, buy. So they are a wonderful team, and we have asked them to come back tonight to tell us about all of the necessary steps required when you are starting to search to buy your dream home. Before we begin, I am going to just have a few logistics to share with you. My name is Patricia Smolin. I am the Business Liaison Librarian with the Schaumburg Township District Library. I'm going to enter my contact information in the chat, as well as that of Linda's and Jean's. I do want to mention that our library is open. We are active. Our reference desk librarians are available to help you by chat or phone or email, but our main number at the reference desk, I'm going to also include it, is 847-923-3322, or you can send us an email at refdesk.stdl.org. So I may also include, as Jean and Linda continue tonight's program, some relevant book titles or sources in the chat feature that may complement tonight's program. And if you want to reach out to me one-to-one or to the library to put any of these books on hold, please let us know. We'd be happy to do that for you. I'm trying to think if there was anything else logistic-wise. Oh, the slides. Linda, can you give us just a brief update as far as the content that you prepared for tonight? How will that be made available to our attendees?
Yes, I am very happy to share the slides with you if you are interested. I'd be glad to get them to Patty so she can get them to you, because she should have all the registrants' information. Correct, Patty?
I do, and that's really generous of you to share them with us. Thank you so much. I know a lot gets poured into this content, and as every time that we welcome this team back, not only do we get an accurate pulse on what's happening with the real estate market, but there is some humor and tidbits along the way that make this one of our finest programs that we can offer. So without further delay, I want to welcome you both and thank you for coming back.
Thank you so much, Patty. And hi, everybody. It's so good to see you. I am live here from my office in Schaumburg. I'm located at the Remax Suburban office right by Gulf and Roselle Road. If you know where Richard Walker's Pancake House is, yeah, that's their marketing plug from me. We are right next door. And I would like to, of course, introduce you to my lender partner, Gene Walters. He is not live from Schaumburg. I'll let him tell you about that.
Hello, everybody. Gene Walters with Home Trust Mortgage. We are located in Schaumburg. We're kind of by Woodfield Mall, basically Higgins and Meacham area. I always like to say it was the Pepsi building, but it's no longer Pepsi, and I can't remember the name, but it's next to the Verizon building. I am not live in Schaumburg, as Linda said. I'm actually live from Disney World. I'm out here on vacation for a few days and wanted to make sure that I was able to make this amazing meeting for all of you.
So glad you could join us. Tell Tinkerbell hello for me. Without further ado, I figure we should get started. I've been a realtor since 2007. It wasn't necessarily the best time in the world to start, but I have learned how to work hard, and I'm still here, which is a good thing. And Gene has over 25 years experience as a lender, and you'll get to know us more throughout the presentation. Feel free to ask questions in the Q&A section or in the chat. Patty's going to help us, I think, try to field those questions. And if we don't field them during our presentation, we'll certainly cover them at the end. Here you go. On your mark, get set, buy. This is a guide for you to learn and understand the process of home buying. It could be, there are a lot of moving pieces to it, and we want to make sure that you're prepared. So you may be renting right now. You may be at a parent's house. You may say, okay, it's time. I'm ready to buy my own place. You need to think of quite a few things. What type of job do you have? Do you have a good source of income? Have you saved some money for down payment? You'll find out that it's not as much necessary as you think later through the presentation. Do you have good credit? And what does that even mean? Gene will explain that to us too later in the presentation. Are you moving in with roommates? That's going to be important because maybe they're going to help you pay that mortgage, or maybe it's a spouse or a significant other. Does anyone moving in with you have pets? Because there might be places that don't allow pets. We want to make sure that you're getting some place that allows your pets. If you have a big dog or a teeny tiny cat, we need to make sure they can be there. And then have you also budgeted for other bills? You're going to have to pay your utilities, your phone, your internet. You're going to have to pay homeowners insurance. We just want to make sure that you think of everything before you think of moving out. So then you need to think about, where do you want to live? Where are you dreaming of being? Do you like the hustle and bustle of a downtown area and being able to walk and have walkability? Do you like apartment complexes or condos? Or maybe you like an attached dwelling that takes care of the snow on the lawn, but you want a bit of yard, so you want a townhome. Or you might want a single family home to give yourself more space. And how are you going to find it? A lot of people start looking on their own on the internet for about 6 months before they even call a realtor or make a move towards actually going to see properties. Are you going to see properties that are listed by owner? Or are you going to work with a real estate broker? These are all things that you need to consider. Who's going to help you get into where you want to go? This is where I want to just talk a little bit about the current market. The current market is very tight right now. And when I mean tight, what I mean by tight is that there is a shortage of inventory. If you've been looking at all, you've been seeing very few listings or very few new listings popping up during your search criteria or your parameters. What happens then is it makes prices go up, just your regular economics of supply and demand. So you need to make sure you have a real estate agent or someone helping you who really knows how to navigate this competitive market. So something you may not even think about when you're thinking about getting a loan is, what's the difference? a lender, a mortgage broker, banker, local banks, online facilities? Does it matter where I get my loan from? And I will tell you, it absolutely does. Having someone that you could talk to, that you could call, that you could ask questions of is very, very important. And someone who has the flexibility to get you the best product available. Jean, can you speak a little bit more to this for them?
Yeah, so a mortgage broker, a mortgage banker is going to be a company that has several investors or lenders at their disposal to put you in the loan that best suits your needs, opposed to a bank, whether it be a local bank or a bigger bank lender, who only has their own products. For example, if you go into a local bank, you will find out that they might tell you, oh, sorry, you don't have credit scores high enough to be able to do this type of program. But really, it's just that they are the only ones that don't allow that. You might find other banks or other investors or lenders that will allow those credit scores. So it's very important to be using a company that will have all the options that are available to you, because Fannie Mae and Freddie Mac kind of govern the rules, but each bank or each investor will have their own set in addition to that. Myself, I'm a mortgage banker, which means that I have the availability to search many different types of loans and programs and investors, but I control the money. I make sure the closing goes smooth, and I make sure everything goes well and get you to your closing on time and with the least amount of issues and surprises. We don't like surprises. We like pleasant surprises, but not the bad surprises. So it is very important that you choose someone that you really click with, that you feel you can trust, and isn't just a yes person. And sometimes you can tell if they're just a yes person.
I've found that sometimes people like to use those quick apps that they have on their phones or that they hear about, like a Netflix commercial, right? But those aren't necessarily people that you can call anytime you have a question, unfortunately. Sometimes it's like a processing center. Is that how that works, Jean, for some of those online?
Right. Sometimes it's in another state. Most of the time, the people aren't available except for 9 to 5. And as Linda can attest, a lot of times you're not looking at properties between 9 to 5. You're looking at properties in the evening or on the weekend. And it's important, if you have questions, that you're working with someone that can answer those questions during the times that you need them. Because especially in this market, if you put an offer in on the evening and you can't get a hold of your mortgage person until the next day, that property might be gone.
Yeah, and this crazy, fast, competitive market, that can certainly happen. So Jean, could you just explain for someone, so if they were to call you, for example, to find out whether or not they'd qualify for a loan, what does the process entail? What do they need to do?
Well, there's a couple ways that we can work it. For those that prefer online or working with inputting information themselves, they can go to my online app, my website, and they can plug in the information. Then we would actually talk about it afterwards. I prefer more of a one-on-one, hands-on approach because I love working with specifically first-time home buyers, and that way I can explain everything. So I prefer to talk to you on the phone, gather all your information, ask the questions that might pop up, because there might be questions that the online app doesn't know to ask because it really doesn't ask questions. It just has you input information. So I look at it as, for those that are somewhat computer savvy from times of old, like an if-then statement. If this, then that. Everything might be different for your scenario. So I would take 15, 20, 30 minutes and gather all your information over the phone. Then that'll allow me to let you know what documentation is needed as well.
Well, and I would suppose during this crazy age of COVID and the pandemic that you pivot to a client-specific comfort level as well. So you meet with masks, or you can meet via Zoom. Have you had to meet with many clients via Zoom or just over the telephone?
Most of the time, it's just over the phone. Yeah,
Okay.
to start.
Okay. So it's not scary. I think that a lot of times we as human beings tend to just not dive into the difficult questions. And sometimes you just got to start somewhere. And once you open that door, you find that it was silly for you to wait so long or to be hesitant or anxious about it. So, so that's definitely what you should do. Now, credit scores, these have a lot to do with whether or not you can purchase, right? You may have an extra $3,000 in your budget per month you think you could pay a house, pay on a house. But if you don't have the right credit score, that's not going to work, is it, Jean? What credit score right now do individuals need to be able to buy a home?
Well, for conventional loans, and we'll talk a little bit more about that, the minimum is 620. With FHA, typically the minimum was 580, but when COVID hit, there was a lot of nervousness by investors and the market, and they do consider historically FHA loans to be a little riskier for the investor, not for the home buyer. So they've kind of gone to a minimum of around 600, 620. Some places are 650. It just depends on the investor that we're using in your overall scenario. But the conventional loans minimum is a hard 620 for sure.
Okay, so you answered the third question on the list, that some of the credit score stuff changed because of COVID, right? And some of the banks are expecting a really high credit score for you to be even qualified. What they do is, what are they called? Overlays, Jean, that the banks or some lenders put on top of the...
Yes, they're called overlays. For example, one of the big area banks decided that they weren't going to take anybody under 700 credit score. And unfortunately, if you went to this bank and you asked them if you could get a mortgage, they would say, no, sorry, you can't get a mortgage unless you're 700. I don't believe, from what I've been told by customers, that they were not being told that it's just their policy. So people were walking away thinking that if you didn't have a 700 credit score, you just couldn't get a mortgage anywhere.
Oh
And
no,
that's
so
just not the case.
their hopes were dashed right away from walking into that institution. That's not good. Now, some clients will come to me and say, well, my credit karma is X score, and then they wonder why they don't qualify, because they may say their credit karma is that 650 you were talking about. Can you explain a little bit about the type of score that lenders use?
Yeah, I actually just did a webinar on this as well. The Credit Karma score, those consumer type programs that give you those credit scores, use what's called the Advantage program, Advantage Credit Program. And it's basically, I also refer to it as a consumer credit. It's basically a real-time, I don't want to say it's fake, but it's just for your own personal use. Nobody really uses that. When you go to buy a car, the car companies use their own scoring models. When you go to buy a house, we use our own scoring models for the industry, and it's a mortgage credit report that we use, and ours doesn't update as quickly. Maybe once a month, maybe once every 2 months, and I think a lot of that is because the creditors get charged money for reporting to these places, so you don't really get the real-time credit scoring that you see on Credit Karma. So you can't really go buy Credit Karma for your credit score when it comes to buying a mortgage. I'm sorry, buying a house, or buying a car, or even getting insurance. When you go to get homeowners insurance or car insurance, they have their own credit scoring model. But it is good to monitor, because it will tell you in real time if there's something wrong. You'll see your credit score drop. If you did something good, you'll see it go up. So it is good for those types of things, and it also tell you if you have something going on that may be fraudulent.
So you said that the mortgage company has their own kind of algorithm that they use to check credit. But if I were to know my FICO score, is it close to what you're looking at?
It can be. It's usually off by anywhere from 20 to 75 points, plus or minus. And what it really boils down to is your overall shape and expanse of your credit. So if you've had credit for a long time, you're going to have a better score. If your balances are low versus your limit, you're going to have a higher score. If you don't have any late payments, if you have late payments but they were a long time ago, that's not as bad. And then they also take a look at your overall spending habits and when you make your payments, even if they're not 30 days late. They call that trending credit. So if you trend to pay your bill after the date that it's due, even though it's not 30 days late, then it will affect your score as well in some way. I just had someone today, as a matter of fact, call me and tell me that they were 8 days late on their credit card. So it wasn't 30 days late, but they saw their credit score drop 10 points. And that's because of the trending credit. If that happens too often, then even though you're not 30 days late, they see that you're a quote unquote a slow payer. So you don't pay 30 days or more late, but you do pay slowly for whatever reason. It could be that you don't have the money. It could be that your paychecks are spaced a certain way, or it could be that you're just not, it's not as important to you to pay on time because you want to pay all your bills at once. You want to, pay your 5 credit cards on the same day instead of trying to remember to pay them 5 times during the month.
Okay. Well, so if their credit isn't where it needs to be, I think you've already answered this in all the answers you've given us from your experience, but can you help them fix it? I mean, questions as simple as, should I close out the credit cards I don't use? Should I make sure to pay this off? Or I have an old hospital collection or something on my account. Should I pay that off? All that kind of information, I'm sure you can help them with. But what else do they need to know that they don't know about credit that we can touch on if we haven't yet in this little slide?
Well, you kind of touched on one big one a little bit. When you have an older collection or a medical collection, people think, oh, I need to pay all these off. And that's not always necessarily the case. If you have a collection that's old, like it's 2 years old, even if it's small and you say, I just want to knock that out, over the long term, it may help you, but short term, it turns that dormant, no longer affecting your credit collection into a recent negative item on your credit report. So sometimes it's not good to work with those. But in general, you want to have your balances ultimately 25% or less of your limits. That's going to keep your credit scores the best. And then have a rounded out credit. So you maybe have a car loan or an installment loan and a couple credit cards. Unfortunately, if you don't have any credit, they don't like that very well. So I work with people to help them build that credit and give them areas where they can establish some credit.
So the answer for not closing a credit card, or don't close a credit card, right? If you have,
I always recommend that you don't, correct, because that takes away an open limit for your overall credit stability. So it'll show, for example, if you have 2 cards that have a $5,000 limit, so you have $10,000 in limit, and you have, for easy math, you have $2,000 on one of those cards. So now you have a 20% utilization, $2,000 off of $10,000 total. So you have an overall utilization of 20%. If you close one of those cards, now your utilization is closer to 50% because now you only have $5,000 of available credit.
that makes sense. Thank you. Thanks for explaining that. I know I always thought if I wasn't going to use a card anymore and it was balanced at 0, I should just close it, right? But that's not
right.
necessarily
And unfortunately, sometimes if you don't use a card for 6 months or a year, they'll close it for you.
right.
So I always recommend that people, not close, but charge maybe, $20, $30, $40 on a card every 6 months if they're not using it, just to make sure that it does stay open. And you could pay it off that next month or pay it off over 2 months, just so that it shows some activity and they don't close you.
And I think typically you get a letter or something from that financial institution saying that your account has gone dormant and they're going to shut it off. So that could be your urging to run out to Target.
Well, lately, the letters I've seen are just, sorry, you haven't used your card in 6 months. We're closing. We have closed your account.
Okay, I see Patty flash on, so there must be a question or two.
There is a question. And I get really nice letters from my credit companies. They start off, I don't know who's writing them. We miss you. We haven't heard from you in a while. I don't think they're sincere. We have two questions, and I'm hoping if we could take a pause. The first one is, what are the best 2 or 3 places to get your credit score? And I think we're kind of in the heart of having that discussion now. And then the second question I'm going to hit you up with, and I'd be glad to repeat it, is I'm told interest rates may be going up in the next few or several months. What have you heard or read? And that's a tough crystal ball to propose to you both. So you can take the credit score question first if you'd like to embed that in, or repeat
Sure.
it, you know, just to emphasize, and then we can talk about interest rates.
Sure. Yeah. I guess the ultimate best places to get your credit scores is probably going to go to each credit bureau directly. You're allowed to get 1 free credit report per year. And I believe they'll give you your scores, however they might charge for the scores. But that's TransUnion, Equifax, and Experian, and you can go right onto their websites. Credit Karma is a very popular one. That's fine too for monitoring. They're not really going to give you your scores that are going to help you in buying a car or getting a mortgage, but that would be a decent place to start for that. For what was the next question?
The trending of the rate going up a little bit from where it has been, right? Oh, Patty, you're on mute.
Oh, okay. So yeah, so interest rates right now have been a little bit on the rise, and with the new administration in and the increased threat of inflation, the consensus is that we might still see rates come up a little bit. However, they've kind of plateaued lately, but it really is going to depend on how things look in the near future with the economy, with oil and gas, and prices, not prices, but wages, with the new $15 an hour minimum wage, and how different companies in the country react to that. That will potentially cause inflation, which will possibly drive mortgage rates up a little bit. The government doesn't directly control the mortgage rates, so they really can't do a whole lot about that directly. But I don't see them going into the 5s or 6s, knock on wood. But I do see them potentially creeping up a little bit, and we're going to see them go up and down. And that did happen last week. They did go up and then kind of came back down the next day or two, still a little bit higher than they have been in the past few months. But we do feel that they will be increasing slightly, but nothing that would be super out of hand. I don't think we're going to see rates like we've seen in the past.
Which is so frustrating, I'm sure, to you as buyers, because the inventory is so low and you're not seeing what you want, or you're not being able to get what you want, but so you have to wait, right? But I guess the good news of this is we're not in the 80s. Weren't there interest rates in the 80s that were in the teens?
Yes.
Absolutely crazy interest rates. So they're still low comparatively to where they have been prior to this.
And I think when you're in the 80s and you're growing up in the 80s and you're seeing that this is like your introduction to interest rates and you're thinking this is the normal, that when it starts to actually go to where it should be down, you're saying, what's wrong with this? Instead of welcoming it with open arms.
This is unusual. Yeah, this is unusual. And unfortunately, if you're trying to watch interest rates by looking online, you're going to drive yourself crazy, because mortgage companies, if they're I'll use the term loosely, silly enough to advertise interest rates, they have to put those rates out depending on the type of media that they're using ahead of time. So they could be shooting themselves in the foot, or they could be underestimating rates, because if a rate has to be published a week to 2 weeks prior to get it into print or to get it into some kind of media, then with rates changing on a daily, sometimes hourly basis, those rates aren't going to be good anymore.
Don't you get a sense, Jean, thank you for answering both those questions, but don't you get a sense that your clients, when they hear those words from you, that they are magic words, you're locked in. And when you hear you're locked in, you know, your clients can breathe that they've secured the good rate.
Well, and I was just going to touch on that too, even though we're not to that point in the presentation, and I don't think I have it in there, is that Jean very diligently, once you're under contract and once you've fully applied and done everything you need to with him, is watching those rates to try to lock you in at the lowest rate possible during that time frame. Now, no one has a crystal ball. If we did, we'd make a lot of people happy to know it's the absolute lowest, or, you know, or to know that it's not going to change 2 days from now. But through experience and education, right, he's able to do something like that. So yes.
Yeah, he monitors it for his clients. Okay, well, I'm going to take a step back, but thank you for addressing those questions.
Thanks, Patty. All right, so now we're past credit. Let's go to the next slide. Now the next thing that I need you to answer for me, Jean. The thing that I find so interesting is that a lot of people just somehow think that they need a really high, big, huge amount of money to put a down payment on a home. And while it's optimal to have 20% down, because then you're not paying the private mortgage insurance, it is not necessary. So you need, if you're renting, for example, you usually need to pay a month's security and first month's rent. Sometimes you need to pay first and last month's rent and security, right? And the minimal you need to put down on something is 3% if you're buying. So you could almost get in for the same money depending on what type of property you're looking for. Is that right, Jean?
That's correct. Conventional loans, so that would be the Fannie Mae and Freddie Mac loans. You can have a down payment as little as 3%. And with FHA, which is a government-backed loan, the minimum is 3.5%. So it really is, you know, there really isn't a huge down payment requirement like a lot of people still think. And part of that is because you go into your bank, and right now, especially, some of the banks are requiring 20% down. They won't do it. And again, you go in and you think, oh my gosh, I don't have 20%. And they don't tell you, oh, but you could go over here and get a loan for 3% down. They just tell you, sorry, you can't get a mortgage.
That's a shame. It's really a shame, but it is a myth that's out there. So that's why we cover that. Now, there are all kinds of different loan products that you can qualify for. And I am not even going to try and broach this subject, except that Jean, being the great mortgage banker that he is, will talk to you about the different programs and help you find the best fit for you based on your situation. And I'll let him explain these different programs.
Yes, there are basically three general types of loans. You have conventional loans, which is Fannie Mae, Freddie Mac loans. You have FHA loans, which are government-backed loans. And then you have VA loans, which would be for veterans. And that's also a government loan. The conventional loans, you have fixed rates and you have adjustable rates. You have interest only on here, and they really aren't doing the interest only loans as much anymore because of the crash of 10, I guess it's been over 10 years now. But fixed rate mortgages are the most predominant, and you can get that with an FHA loan, a conventional loan, or a VA loan. And the conventional loans are underwritten to Fannie Mae and Freddie Mac guidelines. So they have two separate sets of guidelines. Those are basically the same guidelines with very minor differences. And then FHA and VA loans have their own government guidelines that we follow.
Okay.
So we'll take a look and see what's best for you. Adjustable rates normally not not the best. I almost never recommend those. But the government loan versus conventional loan, there could be reasons why we might do one or the other.
And adjustable rates and interest only rate or interest only mortgages are the ones that kind of got people into trouble when the market did crash. Because if you had an adjustable rate mortgage, typically what happens is you have a lesser payment for, 3, 5, so many years. And then your bigger payment kicks in, the full payment kicks in, right? And at that point, people they claim they didn't understand that was what the mortgage was. They were just told that they were paying this mortgage, this premium for the monthly mortgage. And when it changed, they couldn't afford it. And the values of the properties had dipped, which then
Correct. Yeah.
makes it very difficult.
That was a big challenge, even for the ones that knew how the program worked. When it was time to refinance those, the values had dropped. So you were owing more than what your property was worth, and you could not refinance. And the adjustments in rate and payment were so high that it caused people not to be able to afford those mortgages anymore. And some of them didn't realize that's how it worked because they weren't told. Unfortunately, that was allowed. It wasn't supposed to be allowed, but it happened. And the government since then have put a lot of things in place so that things like that don't happen, so that you understand everything prior to going to the closing. And that's part of what my job is, or I make it my job to make sure that everybody understands what they're getting into, what is gonna happen at closing, and that they don't have any of those weird types of mortgages and a fixed rate.
And most of the economists now, I mean, you were talking about this crash, and people are worried that what's happening now is, the precursor to something like that happening again. But the chief economists for National Association of Realtors and other ones are saying that that's not the case. There's no bubble, that, that they don't feel that this is trending towards doing anything like that again. So just to put you a little bit at ease. So then those are the types of loans, but there are sometimes like a first-time buyer program, a down payment assistance program. There are renovations loans if properties need fixing up. What types of assistance programs are available now, and how do you fit people to them as a mortgage banker? And are you able to do most of them, because not all lenders can offer all programs? So for their benefit, can you tell them a little bit about that?
Yeah, so there's we'll go kind of down the list here. The 203K renovation program. If you're looking to purchase a home and the home maybe isn't livable, or you want to do some upgrades, you can actually get money to fix up the house basically, and do those renovations or do those upgrades. And that can be done as a 203K renovation, or Fannie Mae has a home style program, and you can get the money to do that. Now there's always a caveat, or there's always a gotcha or a catch. Those programs are a little bit higher interest rate, but you also cannot do the work yourself. A lot of people are very handy. I am not, so I would never run into that situation. I would have to hire somebody to do the work, but you have to hire a contractor or somebody that would be able to do the work in order to get those payouts. Then there are first-time homebuyer programs. Now there's a couple things I want to go over with that. FHA used to have lower down payment requirements and lower mortgage insurance if you were a first-time homebuyer. However, I think it got too much for the government to keep track of all that, and they just gave all the benefits to everybody. So you don't have to be a first-time homebuyer to enjoy the benefits of first-time homebuyer programs with FHA. Conventionally, with Fannie Mae and Freddie Mac, they have programs for first-time homebuyers that will give you potentially a lower interest rate and potentially a lower mortgage insurance rate. Mortgage insurance is insurance that you pay if you have less than 20% down payment on a conventional loan, and it protects the bank in case you default on the loan. It helps them make themselves whole again a little bit. So those programs benefit, people that have lower credit scores the most, but definitely benefit people that want to put 3 or 5% down as opposed to 20. And then there are down payment assistance programs that change all the time. The Illinois one is IDA, Illinois Housing Department Authority, I believe is the acronym, IDA, IHDA. And they have down payment assistance programs that will help you with down payment and closing costs. However, again, nothing's free. The caveat to that is usually you get a higher interest rate, and you also are limited on the amount you can purchase. They do have restrictions, and they do have income limitations for that. However, it is a very good program for the very few people that fit into that box and absolutely have no way to come up with any kind of a down payment from a gift, from their savings, from a 401k or anything like that. So there are some pretty good programs for that.
Sometimes the loans are forgiven. Sometimes they're grants that, like you've got 5 years and then it's forgiven. So Gene or whomever you work with, and of course we'd love it if you have questions and you'd want to work with us, but whoever it is should be able to explain all that to you so that you're not surprised later.
Yeah, some of them have payments associated with them. There's ones that are forgiven, ones you pay back, ones that are 5-year, ones that are 10-year. So there's a few different ones.
Right. So you got to make sure you have somebody who knows what they're talking about. Now, another thing that I run across in my line is pre-qualification versus pre-approval. And I'm going to do it basic, and then I'm going to let Gene expound on it. So pre-qualification is you talk to somebody on the phone and you tell them, oh yeah, I make $100,000 a year and I only owe like $400 a month on my car. And I think, yeah, I've got a credit score of 750. It's all stated. It's not necessarily all been checked, right? Documentation checked, credit scores checked, and things like that, versus a pre-approval where it is all checked. Gene, I'm sure you can make it sound a little bit better than I did. Mine is the easy version. Is there anything I missed on that? No? Okay.
No, that's, I mean, that pretty much sums it up. Pre-qualification is kind of garbage in, garbage out, so to speak. If you told somebody you make $150,000 a year and you're self-employed and your tax returns only show that you made $75,000 because all your write-offs, well, then you were pre-qualified at the $150,000 a year. So it generally wouldn't entail looking at credit, like you mentioned, reviewing any documents if that was something necessary, and a seller is going to want to see a pre-approval versus a pre-qualification. They might not even accept your offer if you are only pre-qualified, because they know that it's not worth more than the paper that it's written on, basically.
And in this competitive market, a pre-approval letter is submitted with your offer, so that the seller does know that you're qualified to buy. So if you're out looking at properties and you don't have a pre-approval letter, you don't have that yet, you, in this fast-paced market, are wasting your time. So you should really make sure to get that done before you even go out and look at properties, especially if one comes up that you really love. You may lose it because you haven't done that step yet. So this is why we cover all this lending stuff before I even really talk to you about the home buying process, because it's really, really important.
Yes, and a pre-approval is basically good for a minimum of, let's say, 60 days, but really it's only good for as long as you keep your information the same. So if I pre-approve you today, let's say, and tomorrow you go out and buy a car, or next month you miss a payment, or you either lose your job or you get a new job, then all of that basically is null and void. However, if 60 days go by and you haven't done any of those things, then you're still pre-approved and everything is still fine. We don't continually update your credit until you find a property that you want to put an offer on. Then we want to make sure everything's fresh and there hasn't been any changes, then we update the credit, issue the pre-approval letter, and then you make your offer.
Right. So to recap, you want to get pre-approved for a mortgage. If you don't know where to start, your realtor partner will have referrals that they know, like, and trust, and that they can send you to people they know that work as a good part of a team in the home buying process, which is really, really important.
And we both believe that it's important that you use referrals.
Referrals? Is that what I said?
Yeah, it's very important to use somebody that you know, like, and trust. It really is. You might click with somebody, or you might not click with somebody. You might like the way someone talks or that they don't talk, and use your gut, use your instincts on who you feel that you should use. And a referral is always one of the best ways, whether it be a referral from the library or a referral from a realtor or a friend. That's always going to be the best.
Yes, definitely. And as I said, pre-qualification is stated information. Pre-approval requires the paperwork to back it up, and the letters required by the listing agent to prove the ability to purchase. Now, an interesting thing, and it's just this last sentence on this one slide, is that you want to make sure to tell your lender is going to tell you what you qualify for. Okay, maybe they're going to tell you qualify for a $400,000 house, but you realize when you break it down, you don't want to make the payment on a $400,000 house with taxes, because taxes are part of that too. So you need to make sure you tell your lender what you're comfortable paying, so that they can back that up to let the realtor know what your credit card for shopping is valued at the point where you're comfortable at.
Yes, and I think that's very important, because most people don't realize this, but you're not pre-approved on the price of a home. You're pre-approved on the payment of the home. And that the real estate taxes and everything, that payment can fluctuate a lot. And if you're looking in a range that's what you're pre-approved for versus what you're comfortable with spending, then you could be very disappointed. You could be looking at homes that you're going to be comparing to other homes that are in your comfort level for mortgage payment, and sometimes nothing's going to compare to that super higher priced home, because unfortunately sometimes people can get pre-approved for much more than they should be. So whoever you're using as a mortgage guy or mortgage girl, you want to make sure that you're relaying that to them, that this is what your comfort level is. And if you're pre-approved for higher, that's fine. That's good, because then okay, I only want to spend $1,800 a month, but I know I can look at this property that's $1,900, but maybe it'll be less gas I spend every month getting to work, or there might be other reasons why you might be comfortable with that, knowing that you're pre-approved up to $2,200. So
or maybe
keep
I'll
that in
stop
mind.
having my $5 Starbucks every day so that I can afford a little bit more. I tease. Okay. So what you want to do when you're working with a realtor as a buyer, I've had some buyers say to me, well, what do I owe you? How do I pay you? And as a matter of fact, real estate agents are paid by the owner of a property to secure a ready, willing, and able buyer. So if you're my client, you pay me by being loyal to me. I'd say is the best way for me to answer that, because I don't get paid until I secure your home. So what you'd want to do if you're working with a realtor is meet with them at their office, Zoom, over the phone, whatever's the most comfortable for you, and really discuss where you want to live, what you're looking for. You don't need to discuss much your credit and background history if you already have a pre-approval letter. They may give you some recommendations, and this is where you want to discuss your budget. We want you to afford a nice house that you want to live. We don't want you to have to be eating hot dogs and ramen noodles and peanut butter and jelly and have that the only thing you can afford to eat. And so then we set
Not that those aren't delicious.
Not that those aren't delicious. And then we'll set up a search for you to receive potential properties that you'll consider. Now, I, as a realtor, will set up your search in real time. It's a new option in the last year or two that the MLS has given us. And what that does is, rather than give you like every Friday or every 2 or 3 times a week, anytime a realtor enters a listing into the MLS, which is the multiple listing service, and hits enter to make that listing go live, if it fits your specifications that you've already discussed with me, you will be set up to get an email of that property right away. In this competitive market, that's very important, because if you don't see it until tomorrow and it came out today at 1 p.m, it could be gone by the time you've seen it, and you'll be very disappointed. So make sure that your search is set up in real time. So what goes into a search? Well, what does your dream property have to have that fits within your budget? How many bedrooms? How many bathrooms? Do you want a powder room so that your guests don't have to go to one of the main baths that everybody else in the house is using? What kind of yard do you want, or landscaping, or view? Do you need a basement? And if it's a basement, is it just for storage, or is it for living space? Do you need it to be finished, or will you finish it yourself? Would you like a garage, and for how many cars? And does it have to be one that walks you right into your house, right? Or can it be detached? And again, I've touched on this already. Do you have pets? Because if you live in a homeowner association subdivision, there may be rules for pets on breeds or weight restrictions or things like that. So it's very important to go over all those details with your realtor so that the search is accurate. Again, we don't want to break your heart and send you things that, you know, that we think will work and then they won't. So it's best to just divulge everything up front. So your realtor will set up a search, and then this is just a snapshot of what you'll get, a mini snapshot. So on the left, you'll see, and sorry, it's kind of squished. You'll see a picture of a house, and then you'll see underneath a number 1 through 45. That's how many pictures of the house are on. So you could click on that and it will blow up larger on your screen, and you could scroll through the pictures. On top is a see details button with a little house. If you click on that, it'll show you the listing sheet, which gives you the full information on the property. The sizes of bedrooms, should have the flooring on there, should have whether or not the appliances are included. It should have your homeowner association dues and what might be included in it. All that information's on there. And it's really good to use, but the best tool for you and your realtor is the little colored boxes, interested, maybe, and not interested. So when you start looking at properties as a buyer, it starts getting very confusing. Whether or not I've looked at something already, oh, I think I've seen that one. No, I don't think I've seen that one. If you're diligent about marking them, then you'll remember, because once you click on the not interested button, it goes away and it's not going to come back up again, right? Otherwise, you'll keep seeing it on your feed. So you'll want to do that. I can see as your realtor, if you've marked interested, maybe you're not interested, I could see how you've marked the properties. The little box on the right is a notes box. So let's say you went through and really poured over the listing information and went, you know, I really like this one, but the taxes are too high and I'm not sure about that backyard, what it faces, right? You could put those notes in the notes box just to remind you what you've done, because we want you to be able to easily access the work that you've done and keep track of it. It's just a little side note for you in keeping track of these properties. So when you've marked interest in the properties, you're going to decide which ones you might want to go see. If you find a listing online elsewhere, you should let your agent know the address so they can check it for you. Unfortunately, on some of the other websites that people use, those listings aren't always accurate. And the reason for that is a lot of those are actually marketing sites, and I'm not going to use any names, but they use the MLS data to sell leads to real estate agents. So what happens is, if I show you, a consumer, that there are 100 houses available for sale, when really now maybe only 50 of them are, right? 100 draws more people in than 50 might draw in. So it's better for their business model. not to update these things frequently. So sometimes you'll look on those sites and it'll say it's available, and you'll call me and say, Linda, I love this one at 123 Main Street, and I'll look it up and see that it's already contingent. One of the better sites, I have a site on my website you're welcome to use. My website is lindadressler.com. It's tied directly into the MLS. You can use that and it updates quickly. I don't think you need to sign on to use it, but if you want to keep track of your information there, then yes, you need to have like a sign on and a password. You have to let your agent know you want to go see something. So let's say I sent you 10 properties and you marked 3 of those that you were interested in. I'm not going to assume you want to go see any of them, right? Because I set up searches for multiple buyers. But if there's something you want to see, I'm ready to go, right? You call me, you say you want to go today, I try to get you in today. Sometimes property owners will expect a certain amount of leeway in an appointment being set. They may expect 24 hours. For example, if they left for work today already and I want to show their house at 3 and there's a dog in the house that they need to get out, they may not be able to accommodate, but we try, you know, we try our best to get in there. So you want to go out to view the properties that you mark you're interested in. Now I'm happy to go just see one, especially in this crazy market. If you need to go out and see the one that you're like, oh my gosh, I love this, I have to go see it, we'll go. But sometimes we also will schedule like a block of properties, like in a hour or 2 hour span, so that you could see all of them and exhaust the ones that you currently have. And that way you can select your favorite top 3, 4. It just depends on what your list looks like and what your priorities are. I always work to my clients' priorities. I'm not cookie cutter with anybody. It all depends on what you want because I'm in a service industry, right? So this is what the listing sheet looks like. It's a lot more robust than that little kind of cartoon strip thing that you got. And it's really hard to see the information, but you can see there's a lot on there. The top is the property information. The big remarks section is like the flowery information that the realtor puts in to make you fall in love with the property. It's the descriptor, right? That's not just the words explaining how many square feet something is. It gives you a little bit more on the updates and the features of the property. So let's say we've gone out and you find the one that you absolutely love and you want to make an offer on it. And it's listed for $300,000 and the market's really competitive. But would I just let you offer $300,000 without knowing that that's the value? Absolutely not. Part of my job as a realtor is to make sure that it's priced right for the condition and the location. So just like I do comps for a seller, comparable data information on a neighborhood, I'll do that for a buyer so that we know what the price should really be. There are a lot of things that get filled into the blanks of a contract, and all of these things are negotiable. So I'll give you advice on the offer price and give you guidance, but you're the boss. It's your loan, it's your house, it's your dream, right? You get to decide what you want to put as the sticker price on there. In this competitive market, I would suggest that you listen to the best advice that your realtor can give you, because there really isn't any room for making a mistake, because you may not have a chance to fix it. They don't always have to give multiple offers the option to do a highest and best. So you should really come in with your best offer. And when I say best offer, what I mean is the offer that is not going to make you lose sleep either way, not make you think you paid too much, and not make you think you didn't pay enough, and gonna make you just miserable wondering. You have to put in the dollar amount that you're exactly comfortable with. You may have a chance to negotiate after that. Maybe they want more, you know, maybe there are other things that you could change, but I think that that's the best way to put your foot forward in this crazy tight market. You can ask for closing cost credits. We talked about down payment assistance, right, with some of the programs Jean was talking about, but there's an opportunity for me to ask for seller closing cost credits, which means if you offer $250,000 and ask for $10,000 in closing cost credits, they're going to give you $10,000 towards the closing cost credits for your purchase, and they're accepting $240,000 for the property. So if you're in a position where you could use closing cost credits, that's something that your agent can help you with. But remember, then that is actually a lower offer than if someone's coming in at $250,000 with no closing cost credits and you're coming in at $250,000 with the $10,000 in closing cost credits. You're really down here at $240,000. Which do you think they'd want to take, right? You have to kind of consider that. So a lot of people will offer a little bit more than asking if they're doing closing cost credits in this crazy competitive market. Do you have anything else to say on the closing cost credits, Jean? No, okay. You're going to want to mark all the personal property you want to come with the home. Usually there's a listing of what is going to come with it. You know, everything that's attached is assumed except for, you know, pictures and paintings and things like that, maybe mirrors, but light fixtures, anything that goes on the window, the curtains, the blinds, we're assuming are coming with the washer, dryer, fridge, dishwasher, all those appliances. I've also asked for other personal property. I had a client once who goes, oh my gosh, that TV stand with the built-in fireplace underneath it, you know, which was just a plug-in piece. I love that. Can we ask them where they got it? And I said, we could do one better. Let's just ask them if you can have it with the purchase of their house. And they did. They gave it to him. So he was thrilled. So we put the personal property on there. You could also, I always, for my buyers, ask for a home warranty. It covers appliances and mechanicals for you. It's an insurance policy. We ask for the seller to pay for it. I always do, because it gives you some peace of mind. If you've really spent all of your liquidity in getting into this house that you could afford, do you really need the furnace going out 6 months into your new purchase and have to, you know, pay $4,000 or $5,000 for a new system? So we do that. Tax proration is another blank on the contract. And to explain that, it's a little confusing. In Cook County, we pay taxes in arrears, which means we pay in 2021 for living there and the taxes for 2020. So if you're purchasing a house in June of 2021, right, they still owe for probably half of 2020 and whatever portion they've lived in the house for 2021. So at closing, what happens is the seller prepays those taxes to you as the buyer, and you as the buyer will pay that tax bill for them when it comes due. Do you have anything else to say about that, Jean?
No, that pretty much sums it up. You know, the Cook County does things a little weird with the way they calculate the tax bills, and all the other counties do it much simpler. But we would go over that when you can see it happen in real numbers based on the property you're looking at. But yeah, your tax bills are all due in arrears, basically.
So what a buyer's agent usually will negotiate on your behalf is a little bit more than 100%, like 105 maybe, in case something's fudged on the taxes, to give you a little bit of leeway in that. And it's prorated per day that seller lived there at closing. So they give you that dollar amount. And then the closing date is also something that is written in on the contract. So it's prepared for your signature. Remember, you need that pre-approval and a copy of your earnest money check to go in with the offer. Earnest money is your skin in the game. As a buyer's agent, I usually request at least 1% down, depending on how much you're putting down on the house. More money down is more attractive to a seller for some reason. However, I have only seen once an issue with a buyer getting their earnest money back. If you've done all your due diligence and through no fault of your own, there's a reason why you can't go to fruition on the contract and you've met all the contract dates and the things that you're supposed to do, you get your earnest money back. So, but that's again, something that might make it more attractive when you're making an offer in a competitive market.
And that earnest money will then go towards your down payment at the closing.
Correct. So price isn't the only thing that's negotiable, and a realtor's experience is really vital when it makes sure, I was telling you earlier, that it's as competitive as it can be. What happens once you've decided all of that, in this day and age, your realtor may meet you in person to explain the contract and go over and sign it with you. They may send it to you and have you print it out and do it virtually with you, or they may just send it to you via like DocuSign or some kind of electronic signature outlet so that you could do it electronically, especially since, you know, meeting in person, and if it's competitive and you have to do the offer quickly, you know, sometimes DocuSign is the way to go. You could always call your realtor and have them explain the contract as you're going through and hitting enter for all the little initials and signatures that you need to put on it. Each side, when you're negotiation, there are three things. There's either accepting, which usually doesn't happen right off the bat. I think in my 14 years in business, it's happened maybe 3 times that the offer has been accepted without any kind of negotiations. They can reject it, so they can flat out reject it, and they can counteroffer. Those are the 3 choices. And then you as the buyer, if they counteroffer, that's considered a new offer. And then you have the option to do one of those 3 things: accept, reject, or counteroffer. Now, please know, if a seller rejects your offer, it doesn't mean you can't come back with a better one, because all offers have to be presented to the sellers, even if it's under contract. All offers, we are required by law to supply all offers unless we've been directed in writing not to do so by our sellers once they have an offer. Some people are like, oh no, you know, I had 20 offers, I can't go through hearing anymore. And yes, I know that sounds ridiculous, but stuff like that is happening. And I don't say that to scare you. I say that to have you be prepared. So the seller's agent will then contact your realtor with their answer after they've spoken to them about it, and it'll go back and forth until you have a negotiation. Once you've negotiated this, that's when you amend the paper contract. It doesn't have to be amended during those negotiations, and it's signed off on, and it becomes an executed contract. At that point, you need to, in our part of the state, we hire attorneys to help us with real estate closings. They have your best interest at heart. They're your fiduciary partner. You also need to drop off that earnest money check to the listing office or whomever it's directed to by the due date on the contract. Usually it's 1 to 5 days after acceptance of the contract. You'll need to hire an inspector and inspect the property within the first 5 business days. That's what we call the attorney review period, AI period, attorney review and inspection period. If for any reason either party wants to get out of the contract, that first 5 days and before attorney review is signed off on is when you need to do it. That's the best time to get out without repercussions and he said, she said, and more risk of losing possibly your earnest money. So you as a buyer will hire these people. Again, your realtor has people to refer to you for these positions for an attorney and an inspector. You'll have the property inspected. You will go to the inspection. Please go to the inspection. Your realtor goes to the inspection and the inspector goes to the inspection. Sometimes at this point, you may want to invite your best friend to come see the house too, because you're so excited about it, or someone in your family, and that's okay. But I say let the inspector do their job so that they can do it without making any mistakes. The least interruptions while they've got their head down and kind of doing their job is probably the best. At the end of their inspection, they'll actually walk you around the property and show you what they found so that you could understand it. They also can give you a short education on if you've never lived in your own house, where the main water shutoff is, how do I turn off just this sink, right? If the sink is leaking, how do I change the furnace filters or the humidifier filters on your furnace? They're a great resource to you, the inspectors, on the way your house works. They will send you an inspection report within a couple days. Now, the inspector is something that you need to pay at time of service, whereas the attorney will be something that you can pay at closing. So when you're thinking about budgeting, you need to know these things. So you'll take a look at the inspection report. There may be some things that were on there that you didn't realize were a problem, right? Maybe the roof is older and it's leaking someplace and it showed signs of leaking into the attic, and you didn't know about that when you made your offer. Well, you may want to then tell your attorney about things you found in the report and have your attorney negotiate for you. This is what I call the second set of negotiations on this contract. They'll negotiate on your behalf if you want a repair to that property or a credit for that property. Now, when do I ask for a repair and when do I ask for a credit? This is when. If the repair would be done the same by anybody, you or the seller, if it's something like, sometimes there are two wires attached to one circuit breaker, they call it a double tap in your electrical box, and any electrician is going to fix it the same, you could ask the seller to fix it. If you need a brand new water heater because the water heater is just absolutely shot or it's not working or whatever, you may want to ask for a credit because the quality of that piece may make a difference to you. If the seller is fixing it, do you think they're going to buy the highest price one or the lowest price one they can find? Probably the lowest price one. So a credit would give you more of what you would want when you're going to be the one living in the home. Make sure you're packing during this time too, getting ready to go. So now at this point, do we have a question, Patty?
We do have a question. If I can interrupt the packing for just one moment.
Sure.
We do have a question before we get too far. Someone has asked if you could please review again how the earnest money is calculated.
Yes. So earnest money is, it's a fill in the blank actually on the contract. So you could put any dollar amount in there. You can tell your realtor that you only have $1,000 and they can fill that in on there. Even if your property is 250, if that's what you want to put on there and that's what you have, you can do it. But you need to know that that earnest money that check will be cashed. So it's not just a check in limbo until closing that then gets applied to closing. It's going to get cashed. As I believe I said, I typically ask for a minimum of 1% of the property price. So if we're going to offer them $250, I ask you for a check for $2,500. The check has to be delivered to the listing agent's office or whomever is in charge of holding the earnest money, and it will be cashed. You can also, one other blank is state the number of days. So if you need 2 days to get the money together or something to be able to do this, then that's fine. Just let your real estate agent know that so that they don't put 1 day on the contract and then you can't get it together for 2. You'll be in breach of contract if it's not delivered in a timely manner. Does that answer the question? I hope.
I think you went over it well, and I'm just going to wait to hear from the patron, or the attendee. If you could just let us know if that addressed your question completely. Unless I hear differently, I think it has.
We're good.
So we're back onto packing.
Okay, so make sure you're packing. But now we're going to talk about, now that once you've got all those inspection items negotiated fully between the seller's attorney and your attorney, that's the end of the attorney review period. At this time is when I usually talk to people about applying for their mortgage And I'm going to let Jean talk about that, what kind of documentation they need and what happens when they're doing that with you, Jean.
Yes, so you should apply for your mortgage as soon as you have a contract accepted. And at that point, if you haven't already, you should have already sent in the required documentation, which would be things like bank statements, pay stubs, W-2s, possibly tax returns. If there's a divorce or a court order for child support, that documentation would be required. And then what we're going to do with that information is we're going to talk about locking your interest rate if that's something that we should do, or wait a little bit. And then we're also going to get everything together with the processing, verify your information, ask any questions that might need to be asked. We're going to get some information from your employer to make sure that you're still employed and that you're working there. And then we're going to send everything into underwriting. Then underwriter is going to issue what's called a conditional approval. That conditional approval is going to have all the additional information the underwriter wants that we didn't know about or didn't know that they would request. And then we would gather all that documentation from you. Sometimes it's only a thing or two. Sometimes it's a few, depending on your overall scenario. And there's some things on there also that don't have anything to do with you. They might have to do with the seller or the title to the property. So we'll gather all that together, send it in. And ultimately what we're looking for is what's called a clear to close. You will also have a commitment date on your contract. And what that means is that that's the date that you must have a mortgage commitment from a mortgage lender, mortgage company that says you definitely have the loan, that there really is no other questions. Everything's done. They've given it their blessing. And all you need to do now is get to the closing table.
Thank you. But there is something that happens between that time, right before you get your clear to close and everything's going through underwriting. And the reason we tell you not to do this step, which is the appraisal, and you do that through your lender because you have to pay for that. That's another one of those upfront fees that you have to pay during the transaction. The mortgage company will send out an appraiser to make sure that the property is worth that value that you're paying for it. So that $250,000 in the scenario we've been talking about. So you will find out from the appraiser if it is at value, maybe a little over value or a little under value, right? So what happens if it's over? If it's over value, let's say they appraise it at 260, then whoop, whoop, you've got a little equity, right, in your home. What if it's under and they say it's worth only 240? Now it's time for negotiation number 3 in the process, where we try to come to an agreement between the seller and the buyer and the lender and everybody involved to try and still get you through to purchase that property. I can say as a buyer's agent, typically I try to say, hey, Mr. Seller's agent, I understand that we're in a contract for 250, but it was appraised at 240. And they're using the current comps, right? They're using the current information. I did ask for you can, as a buyer's agent, ask for a copy of that, or a listing agent. Sometimes you get a copy of the appraisal to see what comps they used. And I agree with it. And hopefully the seller will lower the price of the house for you. And that's another little gift because it would cost less for you, right? So that's what I consider negotiation number 3. You want to make sure, now this is just a tip. If you are purchasing a property that is part of a homeowner association, I have seen at times attorneys forget to allow for you to review the rules and regulations, the declaration and bylaws, and the financials of the association. You don't necessarily have those when you've made an offer. Those are given to you or delivered to you later on in the process. So you want to make sure that even if attorney review is over, you can back out of the deal. If for some reason you have a German Shepherd that weighs 120 pounds and it will only allow you a 30-pound dog, right? You want to make sure that you're still able to get out of the process. So the last hurdle, as Jean said, is the green light to purchase. It's the clear to close. Those are the three words we are all waiting for to make sure that we can actually schedule the transactions. Many times, as Jean said, there'll be a conditional approval, and usually we'll know what those terms are. You may have to provide something like a letter from your mother that explains the gift that she gave you of money, right? Or things like that. What are some other conditions that people have on their loans, Jean, that are some of the simpler ones to explain?
Usually the earnest money being cashed, proving that it's come out of your account. That's a big one. With COVID now, they're wanting pay stubs all the way up until the closing. So they'll want the most updated pay stub at that time. Sometimes with some of their extensive searches, if you have an easy name or a common name, they might pull up somebody with the similar name in another state that owns a property, and they want a letter from you stating that you never lived there, that that's not you. So there'll be sometimes some things like that. Those are probably the most common ones.
Okay, that makes sense. And you also have to purchase homeowner insurance and have that in place prior to the purchase. You'll have to have at least the deck page. Sometimes it can be paid through closing. Sometimes it can be prepaid. You just need to show proof of insurance. But Jean or whomever your lender is will make sure to go over anything that you need to have done, right? So that you are ready to close. So I propose that you do the walkthrough as close to the proximity of closing as possible. And what a walkthrough is you're just walking through to make sure that the property's been vacated, that it's broom clean. You know, they don't have to hire a deep cleaner for you, but it has to be what we call broom clean. We want to check the list of items that an attorney review, if there were things that needed to be replaced or fixed, that they have been. We want to make sure that the property's in the same condition it was in when we inspected it. So when they were moving out, that they didn't put a hole in a wall or things like that, or left a bunch of debris. Anything unsatisfactory during a walkthrough is brought to your attorney's attention so that we could try to remedy it, either financially or the seller, making some kind of agreement to go back and make it right before you close. Because I've had people who have said, oh no, let's do the walkthrough a week before. Well, what happens if, the house is not in the right condition when you close then? Once you sign on the dotted line, you've bought the house. So we need to make sure that it is completely ready for you as close to the time that you close as possible. Now, I, as the realtor right now, am not a party to the closing. Jean, who typically comes to closings just to facilitate, we just kind of want to make sure everything goes, is not allowed to come to the closing. In the current state of COVID, it's typically only the attorney and the client and the closer, the title company, only the people who are required to make signatures. And I'm very sad about that because sometimes it helps to have your team there. But right now, that's not the way they're doing things. I do try to peek in, though. I've gotten away with it a couple times. There's one title company that knows me, though, and kind of looks at me sideways when I say I want to go in. I just want to bring the keys, honest. They look at me a little sideways, but I feel that we're integral pieces still to the transaction. And if you have questions, we're your counsel, right? So we're always, if we can't physically be there, we're always reachable by phone if you have questions. That's what I like about referrals. You can usually get in touch with the people who are part of the team. So there are going to be other things you want to remember or think about. Find out how to pay your mortgage and pay it on time. You may want to ask about the garbage day. You want to make sure to change the utilities in your name for the day you're closing, because it could be very costly if you don't do that, because if the seller took them out of their name for the day of closing and you didn't think about it, you may not have power or gas, right? And sometimes those utility companies then charge for somebody to come out to turn things back on. So it's much better to do it before you close. Don't forget to arrange for movers or people to help you move. If you're moving into an association, make sure you get your name on the mailbox and the buzzer and get a mailbox key. Sometimes you need a key for a mailbox. Ask for any pool passes, parking passes, where the workout centers, if you're in something like that. And don't break any of the rules if you are in a homeowner association, because they like to charge you when you do break the rules. Make sure you don't. Those are the basic ins and outs, and I am so glad. I can't believe that so much time has passed in us talking already tonight, but I thank you very much for coming. And now is just the big old, do we have any questions?
I think the beautiful part is that we are current with questions. So we're going to leave a moment or two for questions, because I know that our time will wrap up within about 3 or 4 minutes. So we're just going to leave it open for panelists or for participants. In the meantime, let me just express an extreme gratitude for mapping out a very thoughtful and detailed slide deck. I mean, it was really, really phenomenal. And I know that I have sat through this session periodically through the years, and there are certain consistencies, of course, you know, your level of service, always high quality. And then there's always, you know, the devil's in the details of interest rates, processes, you know, additional paperwork. As Jean mentioned, change in the administration, new laws going into effect, everything that the two of you really have to be observant of and then walk through your clients with. Let me take a look and see if there's anything else up on the. Okay, I do have one question. How much money should I anticipate for closing or attorney costs?
Attorneys typically charge between like $400 and $800, depends on who you're hiring.
We estimate average about 500. That's usually a pretty good barometer. And closing costs in general, all together, you're probably looking somewhere between 5,000 and 6,000, including sellers' title charges to you, lenders' fees, credit report, appraisal, homeowners insurance, attorney, all that combined.
But that doesn't necessarily include their 3%, right?
No, this is just closing costs, not their down payment.
Just so that you can get the barometer on that. Depending, so then you'd add your percentage, whatever you're putting down to that. Now your realtor can give you an estimate of expenses, but the better person to give you a better estimate of those expenses would actually be, I would say, your lender. And as much as I love Jean, I say it's your attorney, because your attorney knows more about what the title fees are going to cost you, and they'll coordinate that between the lender too, to get the lender's expenses, right?
Well, a good lender or a good mortgage person, it would be would have the numbers prior to the attorney. If it's someone that is keeping their finger on the pulse of the transaction, I've actually had attorneys give the wrong numbers because they didn't realize that the numbers weren't finalized yet. So I would possibly just check with both.
Okay, both. There's your answer. Check with both. On the selling side, I know we give a preliminary thing as agents too, but you know, the final numbers are always given through the lenders and through the attorneys.
Okay, I have one more question, and I understand that we might get cut out on this question. If for any reason, then you do have Linda Dressler and Jean Walters' contact information.
Yep, and I'm getting kicked out, so I have to go.
Okay, Jean, take good care. We'll look forward to seeing you when you return. Thank you so much for still making time on the calendar to participate in to lead the program with Linda.
Not a problem at all.
Say hi to Mickey Mouse for me.
We will. All right, bye-bye.
Bye.
Linda, if you just have a quick moment to stay on to address this last question. Let's say I find a house tomorrow, given everything involved, some negotiations, the inspections, etc. About how long does it take to complete this entire process, not including move-in time?
Perfect. The process, I always write the contract out about 6 weeks. That gives enough time without any rush to go through the whole steps of the attorney review, the appraisal, getting all your documentation in. If you wanted it faster than that, again, it's all due to your due diligence because you're the one putting in the paperwork. So sometimes we have a delay in finding paperwork, and that's what can delay the process. So as long as you get everything into your lender, you can close as soon as 30 days. You could probably even close faster than that as long as we have enough time for those steps. I've had lenders, Jean included, who's like, oh yeah, well, if pushed, I can do it faster, but optimally it's about 30 days.
All right, well, I think that's a fine question to wrap up with, and I want to thank all of our participants for staying on for the duration, asking some excellent and pointed questions. And of course, Linda, another phenomenal presentation that you brought to our library. Thank you so much for what you do to the community and what you bring to the area and also in your profession. It's really appreciated, very much so.
Thank you very much. You'll notice, I mean, Jean and I are just, we want to give people the education. We want you to know the process that you're going through. We don't want you to feel like you've gone through it and not known what's happening. So if you have any questions at all, please feel free to reach out to either one of us. Patty has our information. Thank you so much for coming tonight.
Thank you. Take good care, everyone. Be well.
Bye-bye.